My name's Dave McCary with McCary Wealth Management. I'll be doing a series of webinars in the weeks and months ahead that will focus on different case studies that help explain what I do for my clients in my wealth management practice. But I'd like to start by giving you a little background on who I am and what sets me apart from other advisors in the wealth management industry. I was born, fortunately or unfortunately, depending how you look at it, into a family of some wealth. My great-great-grandfather was Eberhard Anheuser, founder of Anheuser-Busch, which is the beer company in St. Louis. And because of that, I've spent a good part of my adult life actually managing my family's wealth for the last 20 years or so and helping my family craft a multi-generational wealth transfer estate. The lessons I've learned over the last 20 years have been significant. And it's those lessons, those high points, those low points and struggles that I can share with my clients and often help them avoid a number of the potholes that I've experienced with my family. The areas that my wealth management firm works in are 5: estate planning, retirement planning, insurance review, investment review, and tax planning. And over the next few weeks and months, I'll be doing case studies in each of those areas. So let's get into our case study. This case study covers a client that brought a portfolio into us, and I was able to make some interesting observations, which I'll share with you, and then show you how I improved this client's position. The portfolio that's you're looking at right now was the portfolio that came in. It's not exact. It's very, very similar. This case study assumes the value of this portfolio is $100,000, as well as the McCary Anheuser portfolios that I will put up against this one as part of this case study. Also $100,000 each, so it's apples to apples. The first thing I noticed about this portfolio was, well, a couple things. It was invested in 7 different funds. And when I looked at how it was invested, I saw that it was 43.7% in stocks, 58% in bonds. And then whenever you see a negative cash, that means that one of the funds or more than one of the funds is doing some shorting, which adds that negative cash position. The stock sectors were fairly well diversified. You can see on the right the different sectors that this 7-fund portfolio is in. So there's good diversification. The type of stocks, they were mostly large cap, as you can see here, some mid cap, and just a couple of small cap stocks. They were a lot of growth stocks, mostly a blend of growth and value, and some value stocks. They were mostly U.S. companies, but there were some international and some Japanese stocks as well. 14.5 in Europe and 4.4 in Japan and 3.2 in Asia developed countries and 3% in Asia emerging countries. The bonds had an average term or duration of 6 years with a AA credit quality. And the expenses really, for me, kind of looked high. So that was the first area where I figured I could maybe help this client out. You'll notice that each of these 7 funds, 6 of the 7 were above 0.5% a year. In fact, the most expensive one was 1.27% expense every year taken out of this portfolio. So let's compare in this case study my portfolio to this portfolio that the client brought in. And we'll do apples to apples in the allocation. So we'll take a similar McCary Anheuser portfolio that's 40% stocks, 60% bonds. And you can see immediately that over the last 3 years, which is how long I've had this client and about how long I've had my business available to outside folks, the total return of my portfolio was 14.6%, whereas had he stayed where he was, he would have had 6.5%. A lot of that was because my expenses in all of my portfolios are quite a bit lower. And so right now we're back to the expense page and we're looking at the original portfolio that the client brought in. And now I'll click a button and show you my portfolios. Significantly less expensive. Yet they're similarly diversified, also invested in large companies that are very profitable. So that's a big difference. That's before, and that's with our portfolios. The other thing I noticed was after spending time with the client, I realized that he and his wife didn't really need access to this money for quite a few years. They were both fully and well employed. So that, with a broader financial planning perspective, which is what I also do, I do a comprehensive financial plan for my clients, I was able to comfortably move the allocation to equities higher. And equities over time will always return more than bonds over a long period of time. So let's look at the portfolio that I put him into was more of a 70-30 instead of a 40-60. And we'll see how that also really helped. That's an even bigger positive impact on this client, is that asset allocation analysis and decision making. Now, a 70-30 is not always appropriate for every client. It really depends where they are in their life cycle. But in this case, for this client, we're able to get a 26% return over the last 3 years instead of 6% had he stayed put. So this is one case study, one example of how we go about helping our clients with their finances. We also work with clients in their retirement planning, estate planning, insurance review, and tax optimization. I hope you enjoy these videos, and if you have questions, you can always contact me by going to my website. Simply Google Anheuser Advisor. That's ANHEUSER. Thanks for your time.